Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information. Mitchell Sneddon, welcome to this 4-part series on the Australian Investors Podcast.
Thank you very much, Owen.
Yes, I should actually say it could also go across other podcasts if the overlords behind the scenes at Rask deem it to be worthy of other channels across the Rask network. That's typically how things work. Mitchell, for folks who don't know who you are, you've been on a few podcasts already. Tell us a little bit about yourself. What do you do? Like, what's your role at Rask? What are you prioritizing? How'd you get here?
Yeah, absolutely. So my role at Rask is the head of funds management for the Rask Invest side of the business. I've been in funds management now for about 15 years. Looking after clients and operations across a couple of different managed funded companies in the past, and we've known each other for quite some time. And when you launched Rask Invest, we had a great conversation. We knew our values aligned, and our way of doing business was aligned. So we joined forces, and here I am.
Here you are. And we are recording some podcasts that will go out both on YouTube, hello, if you're watching, and through the audio waves. We will be taking basically people on a journey through not just this first episode, which will focus on kind of how I invest and how we invest at Rask, which will be very interesting to a lot of folks, I'm sure, but also some of the kind of industry myths and some of the tricks and traps that people fall into, unwittingly, obviously, until it's too late. So we're going to take everyone on a bit of a journey. But for the 4th installment of this series, we are, you and I, going to be live and we're going to be answering questions. When we happen to record that installment, you will be here in Australia, I'm assuming, unless I don't know something, and I will be somewhere in Europe dialing in. So we are going to have a bit of fun with that, and everyone is going to send us their questions now if they've got questions about how we invest, why we invest the way we do, and also come along to the live show, which the link will be available in your podcast player. Sorry, it is available in your podcast player, I should say. Mitchell, we are doing this for a very special reason, and that is because Rask Invest has officially launched.
Absolutely. So Rask Invest is now up and running. We are taking applications. We already have investors who have come on board. They've trusted us with their hard-earned money and would like us to invest with us for the long term. So we are up and running. We're taking on funds now. I'm having conversations every single day with our existing investors and people who are looking at joining us. And so, yeah, I'd just like to throw it out there to everyone who, like me, actually, I was originally a Rask podcast listener for many, many years. If you have been listening and you enjoy the way that Owen has been speaking about investing in markets and ETFs, et cetera, and building portfolios over the years, then do reach out and have a conversation with us. There'll be a link where you can book in a chat directly with myself. One thing I've actually really enjoyed, I've been doing a lot of Google Meet chats, so video chats. It's quite different when you're talking to someone and they're walking maybe through the shopping center or half paying attention to you. But the Google Meet chat, so you're sitting there, you can see each other. We're maybe doing some screen sharing, and it's like a really good conversation. And we can get really in depth about what we do here at Rask, but also about the individual, the person that we're dealing with, and what they want to achieve as well, and what they've done historically with their own investing. So they're a lot of fun. So I highly encourage people to use the Calendly link that we have there to book in a time and have a call with me.
Yeah, why not? It's totally free, obviously. So book in a call, say good day to Mitchell, I dial in occasionally to them as well, which is heaps of fun, as well as doing the live shows, which...
I know you were a special guest appearance last week. And
Yeah.
at the last minute, you had some time spare in your diary and you're like, what's the, when do you have your next video call coming up? And lo and behold, to the person on the other end, surprise, you were involved.
Yeah, so it's good. Because, we spent so many years just sitting behind a microphone like this, or in front of it, I should suppose. There's a camera here. It's on the wall. It's looking straight back at me. I know this is your first time recording here in the studio, but, we do so much of it. And a lot of the time we kind of feel like we're cooped up. We send emails, but we don't get to chat to a lot of people and hear stories, which is basically what the world turns on, is a story. So, it's been wonderful. And what I've been really surprised about is people investing, and I would say investing very strongly in terms of the amount of money that they're investing with us. I think because maybe the nature of what we've designed it lends itself to that. But that has caught me off guard, and I'm so thankful for it, and I really appreciate the trust, and I'm humbled. But yeah, this podcast is all about how I invest. So I'm going to hand it over to you, and you can ask me some questions if you will. Ask me anything, any way you like.
Well, I think Rask Invest really has been a product of your own personal investment journey. Right? So we've gotten here, this product has been designed as the outcome of 10, 15 plus years of you being an investment expert and how your journey has evolved over that time. So let's go back to the very start, Owen. Tell us about your first steps into the market and what were you doing?
Yeah, sure. Good question. In episode 2, we'll deliver some of the beliefs and how kind of they form the bedrock of the way I invest now. But if we go back to the very, very start, it started how most people would have started 10 to 15 years ago or even earlier, which is direct stocks. Mm-hmm. Kind of go through these phases of investing. I think there's some commonalities amongst a lot of investors, but typically we start off with owning individual stocks, and I don't see any problem with that because it's what gets people excited about investing. I was a very analytical type person.
Do you remember your first stock?
Yeah, so it was NAB. Yeah, so I bought NAB shares, and this could be, articulated in a very simple phrase that people have heard before: invest in what you know. And for me, I didn't really know the difference between an ASX listed company and a globally listed company, and I just had a ASX brokerage account. And so I was like, Apple, put that in, didn't come up. Microsoft, put that in, didn't come up. And then I was like, well, I walked past the NAB today, I'll just put that in. And it came up, so I bought shares. And it was actually an even more boring company that I made my first real amount of money from, which was Telstra, back when it was $2 or so.
It's when it had dropped from, I remember investing for people at my first funds management job, and that was a really big call that we made back then. When Telstra was about $5, it dropped down to about $2.60. The yield didn't change though.
No, that's the key thing.
So it was a really impressive yield stock then. People think of Telstra now and think of a yield stock. It was really good then.
Oh yeah, so it was paying, for folks that don't remember this long ago, Telstra had this dividend policy where it would pay the exact same dividend every 6 months, which is 14 cents.
It's almost like a corporate bond.
Yeah, people called it the bond proxy because as interest rates were dropping, people were like, well, where can I get my income? And they just looked straight at Telstra shares. Now, as you'll discover in a moment, that's not the best option, but that was the best option then for a lot of folks. And I invested in it. I put some of my mum's money in it. She trusted me with about 20 grand early in the day. And that did really well because if it was, say, $2.60, it's paying 28 cents in dividends, fully franked. It's over a 10% dividend yield on a company that wasn't going to go bankrupt necessarily. It might cut its dividend, but it's probably not going to go bankrupt.
And it was a backbone of our communications infrastructure as well.
Yeah, and there was mobile coming. There was all of these things that, big CapEx spend, but for the most part, it was pretty reliable business.
It didn't stay there long. It didn't stay at that $2.50, $2.60 price long. It was back up over $3, heading towards $4, and I think it hit $5.
That rings a bell. I can't remember exactly.
Yeah, with probably within 18 months of that time frame.
I remember speaking with an investor at the time, and he said to me, I should just redraw all my mortgage and put it in Telstra. He's like, this makes so much sense. It would cover the interest cost by twofold, and I'm not saying that's a good strategy, but he didn't do it. But imagine if he did, that would have been a heck of a goal. He probably would have doubled his money and doubled the income, versus the cost, and a tax deductible loan, mind you, as well. So, that's how I started. And I quickly discovered, blogs. I discovered early days I was on Twitter. That's how I met Kate Campbell, who hosts the finance podcast. We often recount that as I wasn't the strangest person that she'd met on Twitter in person, but I was definitely up there. And that's how we met. We started the podcast together. I went on a journey, discovered some great podcasts in the United States. We I kind of grew from there. And I would say that it took me a few years to realize to first invest in an ETF. I think we're trying to figure this out for the Australian Finance Podcast the other day, but I think it would be now 10 years since I invested in my first ETF.
What was that?
It was the IXJ ETF from memory. I bought two iShares ETFs almost at exactly the same time, which was the IXJ, IXI. And I invested my own money in a really exploratory way, I would say, like traditional younger male type investment strategy where I would have some growth stocks, mostly growth stocks for what it's worth, and really punchy things that I read in broker reports and that type of a thing. And I would try and get quite exotic with things. But then for my mum's portfolio, I'm like, I can't stuff this up. I can't stuff this up. I can't stuff this up. So what did I do? I went to the two ETFs that I knew about at the time, which were those two, consumer staples and healthcare, I believe. And then I bought ResMed, I bought Cochlear, really household names that I just knew I couldn't stuff up for my mum because, bit of a personal anecdote, but my parents split up and so my mum needed help with money. And so that's what it was appropriate for her. Whereas for me, I was still in this kind of cowboy stage for the first probably 2 years, 3 years.
I'm going to guess her portfolio significantly outperformed yours.
Well, it's surprising that you say that. So there's a difference between total return and volatility. So we ended up at quite much the same point about 3 years later. However, the way we went there was extremely different. So she obviously had these blue chips and a bedrock of ETFs, these two ETFs. And she didn't really have a loser in there. I think she had a very small position in Slater and Gordon, which I held from about $2 to $7. And I was fortunate to get out. And for her portfolio, mimic the same thing. But for those of you that don't remember, Slater and Gordon, a law firm, bought Quindell in the UK. And this is a roll-up law firm that then blew up, basically.
This was actually, I really vividly remember this, sitting around a client's table and I was getting a bit of a dressing down actually because we'd sold a chunk of the Telstra that we'd bought from them back in the day. And I was getting a dressing down because the analyst team had sold the Telstra. And said, he's like, my teenage son is a better stock picker than your analyst. He's got us into Slater and Gordon. And it was absolutely flying at the time. About 2 months later, a short period of time afterwards, after said dressing down, Slater and Gordon got its own dressing down.
Yep.
And it came a cropper.
It did. And this was at the time when Slater and Gordon, but also Shine Lawyers was a big thing. Aaron Brockovich, for those of you who don't remember, kind of ambassador there. So this was the heyday of roll-up law firms. And obviously I learned a big, big lesson from that because I covered Slater and Gordon in my job at the Motley Fool. And the big lesson is that for those types of businesses, there's no competitive advantage at scale. It's the classic roll-up analogy is you're going to be there for a good time, not a long time, because they just don't incrementally add value to the mothership.
You've got to know when to get off the merry-go-round.
Exactly. And oftentimes you leave a lot on the table, and if you're in there too late, when the music stops, it really stops hard. And so the actual reason that Mum and my portfolio, and by the way, this is not scripted in any way. We did not intend to talk about my mum's portfolio from way back in the day, but it's a really interesting story of how it maps to something called a humility curve, which is a humility curve was this idea that I came across 2018, I'm guessing, 2017, from a guy called Tim Hansen, who used to write for the Motley Fool and did heaps of things. And he had this idea of kind of like a curve that went up like a parabola and came way back down. And it's this like confidence leads to overconfidence, and then you come back down the other side and you end up investing in ETFs and blue chips. And I see my role at Rask on the education side is to move people from beginner to investing sensibly as quickly as possible and to move across that humility curve, not up it. And I was going way up it. And at my peak, I was investing in things like CFDs. I would pick up a stack of papers, like these papers I got right here. I'd pick up a stack of papers and I'd go through the broker reports, like I'd print them off. And then I'd find in the broker reports, I'd find the stocks that they recommended that were the furthest away between price and intrinsic value. To be like, that is the most undervalued according to these experts.
Did they put valuations on those reports, or did they put price targets?
Price targets, right? Yeah. Which some of the times they'd go intrinsic value. And as we all know, that's a classic rookie mistake because all of those broker targets are so conflicted most of the time.
Short-term focused.
Short-term focused. Price target is 12 months. Is that's what you're alluding to. And Mitch, basically I hit the jackpot. I wrote about this. I found one of these stocks. It did really well. It 14 bagged in 1 year. I made a lot of money. And then I took all that money and then I was at the top of my humility curve, absolute, like least amount of humility possible. And I put it all straight into derivatives. I opened a CFD account, lost $5,000 in a day, put the money in some warrants, came back down the other side. This is all, mind you, in the space of about 3 years.
Wow.
So I had this kind of baptism into investing, which was sensible through Telstra and all that sort of thing, based on what I was learning about fundamental analysis. Thought I'd just have this allocation in the portfolio that just went nuts. Did really well. Didn't recognize the difference between luck and skill. Reading a lot of books over time. Subsequently, I realized all of my lessons. And I came back down the humility curve in a big way, in that things that might look good in a spreadsheet aren't what's necessarily the most important in investing. There are a lot of qualitative factors. There are a lot of human factors, the behavioral finance. But there's also the time factor in that the longer you invest, the more patient you can be. And that might sound obvious, but what I mean by that is like the more patient you can be for the returns to come. And often, obviously, we know that that's a criticism of ETFs. It's not exciting. It's not active, but it actually is. And the longer you have to compound your wealth, the more that makes sense. And we can go into that in later episodes. But eventually, I had these moments where I cleaned out my portfolio. I sold stocks. I realized I was doing the wrong thing. So it was kind of this high growth phase. Realized I was doing the wrong thing, started to shift into more blue chips, quality companies. I did that for over 5 years, I'd say. And then finally, quite a few years ago, I was still investing in ETFs in this time. Things like Moat, which is the Van Eck Moat ETF, Wide Moat Focus ETF. Things like the IVV ETF, VAS, even had a bond ETF. And I started to realize that, hold on a second, I could just invest in these ETFs for the majority of my wealth, still grow wealthy, still learn about investing, and I don't need to worry. Sure, the market might go up and down, but for the majority of my wealth, this made so much sense. So that's kind of, as I've come back down the other side of this humility curve, got to a point quite a few years ago now where I realized that, hold on a second, this just makes so much sense. And I can still learn about investing. It just so happens this weekend, I'm teaching the value investing workshop at the Australian Shareholders Association. Taught the value investing around the country, and I still love doing that. But now I know that the core of my wealth should be invested in such a way. And that makes the most sense, not just for me, for the most people, I think.
I'm curious, out of all of the podcasts you've done with all the guests that you've had, has there been anyone that really cemented that fundamental belief in the core and satellite style investing or the ETF style investing to you that just really resonated with you?
So I think one of the guests that we had on the show, who many people will know, they may not know if we've interviewed this fella, but we interviewed Morgan Housel, the author of the Psychology of Money book, who works for Collaborative Fund, formerly worked at the Motley Fool, and one of the best books of the past 20 years in finance.
I think if you've not read it or downloaded it on any Kindle or whatever it is, or audiobook. I actually had the audiobook.
Yeah, same.
And I just kept on pausing the audiobook to take down quotes.
Yeah.
I think every investor, no matter what your level of experience, it should be required reading that book. And if someone in your life is looking at jumping into investing and getting started, giving them a copy of that book is going to be a game changer.
So Morgan obviously influenced me many times over before we did the interview, because he worked for the Motley Fool at the same time I worked for the Motley Fool. He was in the US, I was in Australia. But reading his book, then doing the interview, kind of cemented the idea of the behavior that we have. That element is one of the core fundamental building blocks for the way people need to invest and need to be mindful. Like in the past, you could have better information. We used to call it the herald effect in stockbrokers. Like by the time the herald reader got some information about a stock, it was too late. We have an analytical advantage. Like some people could do discounted cash flow analysis. Some people had access to a Bloomberg. That stuff mattered. It doesn't matter anymore because everyone has good data and everyone has GPT, right? It can teach you how to do a DCF or just do it for you. It's up to you, right? And the third one is something that the finance industry has been way too slow to adopt. I remember reading the first Chartered Financial Analyst set of textbooks. It's a while ago. I can't remember how long ago it was, but it was a long time ago. And I remember reading that and they were like, there's this new field called behavioral economics or behavioral finance. And I was thinking, no duh, like this is what is finance. It says personal finance. That's at the start, right? But the industry has kind of cottoned on to that in a big way. And so Morgan obviously is a big proponent of that. But I'm going to throw two more things at you. So I invest in a core and satellite approach even today. And the core building blocks, low cost, long-term, diversified, etc. On the more active side of what I like to do is I like to invest in really high quality companies that can compound, that have a competitive advantage for a very long time. On the stock side, there's no one that's influenced me more than Joe Mager, the former director of research at the Motley Fool, but also the co-founder of Lake House Capital and now founder of Seaplane Ventures in the US. By far, I got to know Joe really well, came on the show quite a few times. And you can map the podcast to his journey as an investor as well, because when he was one of the first guests, he just started Lake House. Later on, he was leaving Australia to go back to the US. We interviewed him there. And then when he landed in the US, we interviewed him about Seaplane. And the way he invests, incremental returns on invested capital, high quality businesses. I remember he had this phrase that like he's a value investor in a spiritual way, but not necessarily a religious way, which was really interesting the way he put that in terms of like, I think very strongly about valuation, and he was a great value investor in the way he thought about it, but he's investing in super high quality companies. So seeing that there's a qualitative angle to value investing was really, really interesting. And I think a lot of people that listen to the show would agree. But there was another guy, and he probably wouldn't remember this so much, but there's a guy called Angus MacLeod, never appeared on this podcast. He was actually a portfolio manager at Vanguard. And I met him many, many years ago when he was a portfolio manager at Vanguard. He's since retired. And he may or may not remember this, but he left Vanguard, and I caught up with him when I went out on my own. And I think we went for some of the blueberry pancakes at Higher Ground, I think it is, or one of the cafes down, I don't know, in Richmond somewhere, or Cremorne in Victoria. And he's obviously a big Vanguard guy, right? Like huge. He kind of like waved the flag for them in a massive way here in Australia. And I remember sitting with him and talking about all the stocks and things that I was interested in. And he said to me, there's nothing wrong with a core and satellite approach. But he's obviously massive passive investor, done extremely well, super smart bloke, and he went on to blog and do these types of things. But he probably wouldn't remember this, but just him saying that, there's nothing wrong with that. Whereas I'd been taught that you had to choose active or passive.
It was one or the other, yeah. It was like religion.
Exactly. And he was saying, you know what? Sure, but most of your wealth's going to be made in the core. That's effectively what he was implying. I think, Angus. Sorry if I've taken that out of context, but that's effectively what he was implying. And I think that's an important distinction, an important nuance of investing is we're often forced to choose and we don't have to.
How are the pancakes?
I couldn't get through them because they're so massive. If anyone's been there.
I think I've been there. I think I know the place.
Yeah. They're the size of a dinner plate and as thick as a textbook.
Yeah, that's too much for me.
And it's got, I think it's like ricotta cheese or something on it. It's just like, it's full on, but it's delicious. And it's like a bit of an institution. So I think he ate mine actually. The passive investor's very hungry. Yeah. So those are some of the people that have influenced me. But we've done 1,000 podcasts at Rask now, and I've been a part of almost all of them.
I remember listening to the Joe Mager ones. I remember that was one of my first introductions to. I went back through the back catalogue when I first found your podcast, and I went back through the back catalogue, and I remember Joe's really specifically for a few things how he got started investing. Yeah. So his lake house comes from the name of his grandfather's that he had a log cabin, and his first foray into investing when he turned 13, his grandfather would always buy.
That's right. Good memory.
Yeah, I looked this up. I remembered it, but then I was talking to a Rask Invest investor, and he was looking to get his kids involved in investing. I remembered there was a really good investor, and I thought it was Joe Mager. My memory turned out to be correct, and his grandfather, when he turned 13, bought all of the grandkids a special present because he thought 13 was a really special birthday, and his cousin got a gun. Of course he did, American. Sorry, Americans who are listening. But he got a couple of $100 worth of shares in America's largest carpet manufacturer.
That's great.
Yeah,
that's great.
It's a really
I
good
only
story.
vaguely remember that.
I went back and listened to it again.
That was so long
ago,
a
week and a half ago, because I was talking to this client.
I think that's the type of episode. I think when we think about what we do at Rask,
you were very young.
Oh,
you were fresh.
I had a full head of hair. I was probably 20 kilos lighter. But I think we've been so blessed to have so many wonderful people come on the show. I kind of picked that up from my time at Zenith, which was an investment firm that I worked at briefly here in Melbourne, which my job was to interview fund managers. And I remember on the second day, interviewed Jacob Mitchell, the founder of Antipodes, who came out of Platinum. And then within like a week or whatever, speaking to Hamish Douglas from Magellan. And what I realized is that all of these so-called gods of Australian investing and global investing in that instance are mortals, and they had an investment process that they followed, and you should focus on the process and
they're all really willing to talk about it and give that knowledge as well. They're super lovely people. Yeah,
they are. Hey, I'll give you one final thing before I know we've got to move on, but Tony Hansen, who was the third guest on the show, EGP Capital, zero fee fund manager based out of Sydney. One of the big reasons that I wanted to get him on the show early days, other than just him being like a relatively unknown commodity, I read his letters and stuff, was he was the only one who warned me about Slater and Gordon. He, with his accounting background, identified a work in progress anomaly, which is basically, for folks who don't know, in a service-based business like a law firm, what happens is you can bill a client, even if they don't pay, you can bill for works done, but the cash flow not completed. So effectively what was happening was they were building up this huge bank of work in progress that had yet to be billed or had been billed but no cash flow received for. And it is shortened to WIP. And Tony sent me a random message when I had about 200 followers on Twitter. And he said, "Hey, mate, I know you've been writing about Slater and Gordon. You should check out this." And I think he sent a screenshot of this, because it's basically the connection between the income statement and the cash flow statement, for those of you that don't know. And you can bury that in something called the reconciliation of profit to cash flow. Not to get too nerdy, but you can bury it in there. And he sent me a screenshot. And that is ultimately what blew up Slater and Gordon. And if you let's take a backward step from accounting. The reason that it was a massive problem is because, and most contracting businesses have this problem as well, is because a lawyer would be incentivized to bill for work they were probably not going to complete, or bill for work ahead of time to meet bonuses, or bill for work and never actually win the case or recoup the costs. So effectively, you end up with something that is actually somewhat of a bad debt, an unearned revenue figure that just spirals out of control. He was the third guest. The first guest was Wayne Peters on the show. I met him in a hotel room. We met him in a hotel lobby then, recorded in his hotel room here in Melbourne. And once again, I met him through Zenith, and I was just blown away. And the lesson that I took from him, not just from that episode from when I first met him, was that he had a massive cash balance that he always dragged around in his portfolio. And the reason he did that is because he was so scarred from the GFC. I think that's why. And so he was a wonderful investor, but always too scared to commit because of how volatile the GFC was. This was my inference. And it taught me that you can be a great investor in a professional capacity, but if you have a huge cash balance, your performance is always going to be subpar. And so there are fund managers that have huge cash balances that always get what we call a cash drag. And so they can be great stock picking, but the reality is they'll still underperform an index because they're too conservative.
Let's jump forward. So you're now really focused on core and satellite. We talk about core and satellite all day, every day with our investors. Let's talk about what your core looks like here. I know you are actually invested in Rask Invest, so you're eating your own cooking, but let's talk about your core, and inevitably that is essentially what the Rask Invest portfolios are built around, the fundamental lessons of what you've got in your core.
Yeah, so for all intents and purposes, I'm a professional investor, right? That's my job. That's your job, in effect, as well. And many people who come on the show. And we are paid, in the case of Rask Invest, I would say a very low fee to manage people's wealth. And we do that in a multi-asset way, in that we also manage people's portfolios if they've got a retirement need and they're looking for bonds or fixed income and they need consistent income. But I'd also say that our approach to what we do is almost multidisciplinary in a way, because we've acknowledged that behavioral economics is playing a huge part in the modern investment ecosystem and how people actually manage their money. But we can come back to that another time. The way I actually invest, and the reason I use a core and a satellite approach, is because I think I'm now humble enough to know that I might be great at identifying businesses to buy, but maybe I get the timing wrong. Maybe my valuation is slightly off. Maybe someone does something that's I would deem to be irrational inside a business and it ruins it. Maybe there's a disruption. Maybe there's something like this. And although I would think that I could maybe do okay from that, that's a lot of effort. That's a lot of my life. It's a lot of my team's life, when we could go extremely close, if not have a better outcome from investing in something that is sensible, diversified, low cost, transparent for the ultra long term.
All the stats suggest that that is the higher, more likely chance.
Yeah.
Like if investors out there look up the SPIVA, S-P-I-V-A reports from S&P,
yeah.
You can go across the US, you go across the globe and see how active managers have performed against the passive alternative. And I know if you look at the 10, 15-year kind of time period in Australia or the US, the numbers are pretty similar. You're seeing about 85% of people who are active, professionals who are active, not just people on the street, but professionals, underperforming those stock standard benchmarks that you can get in a core investment approach. And there's a number of reasons for that. One, I think large caps are really, really hard to outperform. You've identified lots of different technological advancements that have happened in the last, 10, 15 years that take away a lot of investors' advantages.
Yeah.
And so brings more people towards that average.
Yeah, that does. Yeah, if you think of investing through the three dimensions, you've got, which we referenced before, the behavioral angle, we've got the informational angle and the analytical angle. If you think about a professional investor's toolkit, they have effectively the same tools as the rest of us now, with a few minor exceptions. I'm talking about public markets here. In private markets, which is another place that I like to play, that's a very different perspective. And we were talking about this a few hours ago. If you think about the informational advantage, there's really none anymore, and there shouldn't be, not in public markets anyway. And this is where I have this view that over the long term, what we will also see is a lot of the returns drift towards the fundamental growth of companies. When I crunched 150 years of stock market data from the US, I found that on average, corporate America is increasing earnings per share at about 7% per annum. And the stock market has exceeded that in the United States, around 11%, a bit more depending on the time horizon, a bit less, whatever. And a lot of that could perhaps be put down to valuation expansion. But a good analogy of where public markets have gone is if you look at, say, like realestate.com.au and the Australian property ecosystem. I remember chatting with Pete Wargent. He was a guest on our show, one of the first guests, believe it or not. And also the most prolific selfie taker, if anyone knows Pete Wargent.
He's got a good head of hair.
He does have a great head of hair. And also, he now hosts our Australian property podcast, and he's a macro consultant for our Rask Invest service. So it's like
he's on the investment committee.
Yeah. So full circle, hey. So Pete and I used to talk about this, and that basically, like, what REA Group and these types of platforms have done to property is remove the information asymmetry. So you can search your area for a property, and you can search by price. You can call the most opaque it gets is calling your real estate agent to see if there's an off-market property. And that's, you go into a database with probably 50 other people, or maybe your buyer's agent finds something that no one else really knows about. And that can happen still. But the reality is that for most of the property market, it has become information efficient, which also means that it's probably become analytically efficient as well to an extent. And if you think about that and you listen to this, you're like, what is he talking about? What I'm talking about is basically you no longer have a clear and distinct advantage over the next investor. And so the fortunate reality of investing in the stock market and investing through ETFs is you get the market return, which is actually a wonderful thing. In the Australian market, over 124 years or so, the Australian stock market has returned on average 13%. That's a very high return. I don't expect that going forward.
No, it's if you shorten that time period to, say, more recent, the last 20 years or so, or 30 years, I think you're coming in at about 8 to 9%. We're a shade below the US.
Yeah, we are. Interestingly, since the year 1900, so in that time period, look at us coming out with different time periods. Since the year 1900, I believe Australia's stock market has come in second behind the South African stock market.
Really? I wouldn't have picked that one.
Yeah. And the US is in the top 5, I believe, but it's not number 1, which is quite interesting and catches people off guard. But if you think about it, what we're basically talking about is markets that are maturing, technology is advancing. And so while I still think there is opportunity for active fund managers and individual investors to outperform, I think for the majority of people's wealth, what we should all get used to is investing in kind of just to get along, to go along, to invest in a way that captures the market return for virtually nothing or virtually a very low cost, and focus most of your attention on the behavioral side of what you're doing. So if you're a young person, it means earning more. If you're an older person with a bigger balance, it means getting professional help to make sure you don't stuff it up. And to understand what you invest in, but just don't stuff it up. As your nest egg gets bigger, you want professional help. You need to have a plan, these types of things.
Now, let's talk about how you've actually constructed these core portfolios in Rask Invest. Let's talk about strategic asset allocation versus tactical asset allocation within these portfolios. So how have they actually come together? How have you decided, you and the investment committee decided, how much Australian equity should we have? How much international equities is appropriate? Bonds. I know cash is actually quite divisive, actually. You were talking about fund managers holding a whole whack of cash in their portfolios. Throughout my... I know that there's nothing more that annoys an investor, especially a high growth investor, and they're seeing cash in their portfolio.
Yeah.
They want that in the market being put to work, et cetera, et cetera. So how do you decide the percentage of cash to go in, say, in a high growth portfolio? Let's talk us through that.
Yeah, sure.
That strategic asset allocation.
So there are effectively three strategies: 90-10, 70-30, 50-50. What that means is 90% growth, 10% defensive. And what goes into those different buckets is the answer is it depends. But if you think about those numbers, 90-10, 70-30, 50-50, that is what we call strategic asset allocation, or SAA. And basically what that refers to is it's the finance world's best approximation for how you can map your tolerance for financial risk to an investment portfolio. So if you're at 90, it means you have a high risk tolerance and you're willing to take risk in order to achieve a long-term objective. Interestingly, Morgan Housel's definition of risk is not achieving a goal, which is probably a simpler and more eloquent way to describe risk. But when it comes to financial risk and how we interpret it in the investment markets, it's how do you map someone's behavior or implied behavior or expected behavior to a portfolio that is mixed between defensive and growth assets. And so we have interesting names for these so you can remember them. 90-10 is Jupiter, 70-30 is Martian, and 50-50 is Terra. Think about it, the further away you get, the higher the risk, the more, like it'd be more difficult to go to Jupiter than it would be to go to Mars. I think Elon Musk will tell you that. But also, if you think about terra firma, the land that we stand on, it's all about sustainable returns, sustainable income, sustainable returns. And that's what a retiree wants. So that's why that's built that way. Also happens that I happen to be obsessed with everything space and technology related that goes into space. So that's an added quirk of being able to name things. But basically, we've constructed them this way so that a retiree can have a core portfolio that focuses on passive income, someone who is maybe in retirement or maybe approaching retirement, or even a little bit younger but not as dialed into how finance works but still wants to grow, they could choose that 70-30 option. You still get some income, but you'll have some growth. All of them have income and growth. It's important to understand that. And finally, the 90-10, which is the highest risk and also the highest growth. But I want to really just double click on that for a second. People might think because one is 50 and one is 90 in terms of growth, you might be thinking it's nearly 100% more growth. It's not the way it works. In finance, there is this kind of sweet spot that if you get to a certain point, adding the same amount of risk that you took to get to that point would actually result in negative returns. So meaning that there is a point where if you go too far beyond that, you take too much risk, you will actually find that your returns would likely fall. And there's a heap of portfolio management theory around this. But the best illustration is that over the long term, I would expect the 90-10 portfolio to only incrementally outperform the 70-30, to only incrementally outperform the 50-50. But the path to get there might be quite different. And in the meantime, the makeup of those returns will be different. An accumulator who picks the 90-10 probably doesn't want as much income coming back to them because they want to keep compounding. So they might go for that option because they don't want to stream the income back. But a retiree who's in a 0% tax environment in an SMSF, for example, and invested with us, happy days. They don't really care. They want it all. So they can stream the income back to them. Over time, if you took that return, it would be not comparable, but similar. But the components of that return would be different.
When you look at any multi-asset class portfolio out there and you see your traditional names like conservative, balanced growth, high growth, you look across them and if you look at the annualized numbers at the end of the day, you'll probably see something like 8% at high growth and then it trails back.
Yeah.
And that's what you should expect to see at the end of the day. Of course, as you know, you don't know what the makeup of that is, or the split between income and capital growth. But what those annualized returns really hide, as you hinted at, was the journey that they took to get there.
Yeah.
And that's what a lot of investors don't appreciate, that those wild, sometimes quite wild swings and dramatic swings to end up at the same spot, just like coming back to full circle, like how your original portfolio and your mum's portfolio ended up in the same place. Yeah. One taking on a lot more risk and the other being a lot more stable.
Yeah, we're definitely not investing that way in our high growth strategy. I can tell you what, this is an interesting point, is that you can, because of ETFs and the way that they're built, constructed, conceived, however you want to frame it, you can have the same building blocks but get a different outcome. And that's effectively what happens with these three portfolios, Terra, Martian, and Jupiter. Their building blocks are almost identical. And we've been doing this for a long time with our members, but the building blocks are almost the same. The way they're mixed is what matters. And I like to think about it, Mitch, as if, we charge a very small fee of 0.55. That's percent. That's a management fee.
Percent per annum.
Yeah. A very small fee if you do the calculations yourself. But I like to think about it that if you put those, depending on how you put those together, when you put them together, and how you react when things go wrong, the difference of a behavioral disadvantage is far greater than 0.55%.
It's massive. And there are actual calculations on it, which I think we'll be getting into podcast number 2 of this series.
I'm getting ahead of myself. But I think that we've moved into a point where everyone's got similar tools. So how can you build something, keep people informed, and guide them towards long-term wealth creation and, have a sustainable business, let's be real, and secure and all that sort of stuff? Well, this is kind of how you do it. And the key ingredient to all of this is having the financial literacy and the education in a community that understands, knows what they're invested in because people are telling them, they're not hiding anything, and they can understand the process. I think that's almost a behavioral competitive advantage.
And the legwork on that started all those years ago when you were in the hotel room with Wayne Peters.
Well, yeah. I was very blessed that I could learn from some of the greatest people this country has ever produced in terms of investors, both active and passive for that matter. And not only that, international guests and authors and fund managers. And we are very blessed in who we've had, not just in this studio, but in our virtual studios. And I've got to pinch myself, and not just me, but our whole team. We can walk into the office and there's a founder that's created billions of dollars of wealth for someone, and they're wonderful people and they're generous with their time and they share that with us because then we can pass it on. And that's a very, very special thing.
Awesome. Owen, I think that's a really good spot to finish up on. Thanks for sharing, especially the personal anecdotes. They're great, especially the story about your mum and her portfolio and your portfolio. I know we had no intention of going there, but we got there anyway.
Yeah, we got there. And it's probably reflective of how most people are thinking about and building portfolios. And we're very fortunate that worked out the way it did. And shout out to Mum. Probably like you said, probably the better investor. Maybe it should be her on this podcast. But mate, I really appreciate it. And thank you for your time. We'll be back in episode number 2. We're going to explore the bedrock of all of that and how basically the goalposts are erected around an investment strategy, where they come from, and some of the more, deeper literature around that. So I'm excited for that. But Mitchell, absolute pleasure. Thanks for joining me.
No worries, Owen.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.